If you look at the headlines today, April 30th, 2026, uh, Amazon just posted this massive $181.5 billion first quarter.
Right. The numbers are just staggering on the surface.
Yeah, they really are. But if you ignore the bold print of the press release and actually dig into page 40 of their really dense 10Q SEC filing, you'll find a detail that kind of changes the entire narrative.
Oh, absolutely.
Because their free cash flow just plummeted by 95%.
Yeah, and that massive disconnect between the headline revenue and the vanishing cash flow is the exact reason we are diving into these sources today.
Exactly.
Because we want to give you a fast, thorough, entirely jargon-free understanding of what is actually happening inside one of the world's largest companies.
Right. And to do that, we're looking at a whole stack of documents. We've got Amazon's Q1 earnings slides, the official press release, that 10Q filing you mentioned, and curiously enough, a single security verification page from a Right. Well, I included that market B page because it's kind of the perfect metaphor for what we are doing today. It pops up, says, performing security verification, and then it asks you to, click a few traffic lights to prove you aren't a bot.
Right, yeah, the classic KPCHA.
Exactly. It forces you to verify reality. And that is exactly what we need to do with Amazon's numbers right now. We need a bot check.
We really do.
Because on the surface, the figures are just blinding. I mean, net sales up 17% to $181.5 billion. Operating income up 30%, and the real crown jewel here, net income up a staggering 77% to $30.2 billion.
Yeah, to a casual observer, a 77% jump in net income looks like, the greatest quarter of operational growth in corporate history.
Oh, completely.
But when you apply that bot check and actually read the footnotes in the 10Q, the reality of that figure shifts dramatically.
Okay, let's unpack this, because getting to the bottom of that 77% jump was probably the most revealing moment in reading through these filings for me.
Oh, for sure.
That $30.2 billion in net income, it is not from moving millions of extra cardboard boxes or even just selling more cloud storage. Included in that total is a massive $16.8 billion pre-tax gain entirely from their investments in a single AI company.
Right, Anthropic.
Yeah, Anthropic.
And understanding the mechanism behind that $16.8 billion is totally crucial because it highlights the difference between paper wealth and actual usable cash.
Right.
So earlier, Amazon bought what are called convertible notes in Anthropic. And you can think of a convertible note as basically a loan that have the potential to turn into equity later on.
Like stock.
Exactly. So during this first quarter, Anthropic's valuation just skyrocketed in the private markets, and a portion of those notes converted into non-voting preferred stock.
So they suddenly own shares in a company that is worth vastly more than when they initially, handed over the money.
Precisely. And under current accounting rules, when that conversion event happens, Amazon is actually required to record the new value of that asset based on observable market prices. So boom, Amazon gets to record a $16.8 billion gain on their income statement. But, and this is the distinction that really matters, that is purely a paper gain.
Right. It's an accounting illusion.
Exactly.
Yep.
It is not liquid cash flowing into Amazon's bank accounts from their day-to-day operations.
It's kind of like finding a $20 bill in your winter coat. But in this case, the $20 bill is a $16.8 billion paper gain on an AI startup.
That's a great way to put it.
Or it's like getting your house appraised. If the appraiser walks in and says your home is suddenly worth $1 million more than you paid for it, your net worth looks amazing on paper. You feel rich.
Yeah, you feel like a millionaire.
Right, but you can't actually take that $1 million to the grocery store to buy dinner unless you actually sell the house.
That is the perfect analogy. They haven't sold the Anthropic stock. They're just holding a newly appreciated asset. Which is exactly why focusing solely on the net income line can be incredibly misleading for investors.
But this raises a major structural question for me. I mean, if more than half of their net income for the entire quarter is just an investment gain on a single AI startup, what does that say about the rest of the company?
Well,
Are we looking at a situation where the core retail and cloud businesses are actually stagnating and Amazon is just operating as a massive AI hedge fund to mask the decline?
what's fascinating here is that the core business is actually performing exceptionally well, which makes this whole accounting quirk a strategic signal rather than a red flag.
Okay, how so?
Well, if we isolate AWS Amazon Web Services, their cloud computing division, it generated $14.2 billion in operating income all on its own.
Wow.
Yeah, that is a 23% increase year over year. The core engine is absolutely humming. So this $16.8 billion paper gain isn't a smokescreen at all. It is actually a neon sign pointing directly toward Amazon's ultimate strategy for the next decade.
And that leads us straight into the sheer scale of the capital they are throwing at these AI companies. I mean, reading the financial commitments detailed in this 10Q, I had to reread the paragraphs just to make sure I wasn't adding an extra zero in my head.
Oh, I did the exact same thing. The scope of the deployment is historic, even for a company of Amazon's massive size.
Right,
So let's just look at the numbers.
right.
On top of their previous investments, they just initiated a new $5 billion investment into Anthropic, and that's paired with a $20 billion financing facility.
It's staggering amounts of money.
And they aren't playing favorites either. They also dropped $15 billion into OpenAI's Series C funding round, while signing an equity commitment letter to buy up to $35 billion more in OpenAI stock.
Wait, so we're talking about $75 billion in realized and potential capital commitments directed at just two artificial intelligence companies.
Yep, two companies.
Yeah.
But the strategy only really makes sense when you look at the reciprocal nature of these deals. Because Amazon is not acting like a traditional venture capital firm here. They aren't just buying stock and hoping it goes up. The SEC filings reveal the other side of the contract.
Which is what?
Well, OpenAI has committed to consuming 2 gigawatts of Amazon's Trainium chip capacity starting in 2027. And Anthropic is securing up to 5 gigawatts of capacity.
Hold on, we need to contextualize those numbers. 2 gigawatts, 5 gigawatts. To most of us, I mean, a gigawatt is just a fictional measurement Doc Brown yells about in Back to the Future.
Right, exactly.
What does that actually mean in terms of physical computing power?
To give you a real sense of the physical scale, a standard nuclear power plant produces roughly 1 gigawatt of electricity.
Oh, wow.
Yeah. So when we say Anthropic is securing 5 gigawatts of compute capacity, Amazon is essentially building the equivalent of 5 nuclear power plants worth of energy and infrastructure purely to run Anthropic's AI models.
Okay, but if I'm looking at this critically, Amazon is handing OpenAI and Anthropic billions of dollars in funding. And then OpenAI and Anthropic are turning around and handing billions of dollars right back to AWS to pay for those exact gigawatts of compute.
Yes.
Aren't they just artificially inflating their own AWS revenue? I mean, it feels like taking money out of your left pocket and just putting it in your right pocket.
On a short-term spreadsheet, yeah, it might look circular. But if we dig into the mechanism of the whole Amazon flywheel concept, the underlying brilliance becomes really clear.
Okay, explain that.
Amazon wants to be the foundational layer, like the electricity for the entire AI revolution. By providing these massive capital injections, Amazon ensures these companies have the funding they actually need to survive.
Right.
But with a major string attached, they must build their futures on Amazon's proprietary hardware.
Oh, I see. So they're essentially saying, we will fund your war against your competitors, but you have to buy all your weapons, your armor, and your rations exclusively from our store.
Exactly. And not just any weapons. Amazon's custom silicon.
Right.
The filings note that Amazon's custom chips, so that's Graviton, Trainium, and Nitro, they've now topped a $20 billion annual revenue run rate.
That's huge.
It is. They have deployed over 2.1 million of these AI-specific chips in just the last 12 months alone. They are actively weaning these AI companies off their reliance on standard NVIDIA chips and locking them directly into the Amazon Silicon ecosystem.
Which gives Amazon a massive advantage on the consumer side too, right?
Oh, absolutely.
Because the press release mentions that Amazon Bedrock, which is their cloud service where businesses can basically rent AI models, is now offering OpenAI's GPT 5.4 and Anthropic's Claude Opus 4.7. So Amazon gets the best models for their own customers too.
Right. By securing the two biggest players onto their custom AWS silicon, Amazon is basically ensuring that regardless of whether OpenAI or Anthropic ultimately wins the AI model war, Amazon inevitably wins the infrastructure war.
Yeah.
They are selling the pickaxes for the AI gold rush, and they are funding the miners to ensure they buy them from Amazon.
That strategy totally explains why AWS is just printing money right now, but it also brings us back to the most glaring paradox in the entire 10Q filing.
With the cash flow.
Yes. If the core business is thriving and they are locking in the future of AI, why is their trailing 12-month free cash flow dropping by 95%?
It's a huge drop.
I mean, just a year ago, they had $25.9 billion in free cash flow. And this quarter, it is down to a mere $1.2 billion. Where did it go?
Well, that drop is the exact difference between net income and free cash flow we were discussing earlier.
Right.
Free cash flow is the actual cash generated by operations minus what a company spends on capital expenditure, so things like buildings, servers, and physical infrastructure.
Okay.
The cash didn't vanish because the business is failing. It vanished into literal concrete and steel because their capital expenditure is at a scale we have rarely seen in modern capitalism. Over the last 12 months, their purchases of property and equipment skyrocketed to $147.2 billion.
Here's where it gets really interesting. When I saw that 147 billion figure, I literally had to double check to make sure I wasn't misreading the chart.
It's a surreal number.
It really is.
Yeah.
What exactly are they buying that costs $147 billion in 12 months?
Well, a massive portion is obviously going toward the data centers to house those 2.1 million AI chips we talked about. But it is going much further than that. They are building entirely new physical and digital ecosystems.
Like what?
Look at their acquisition of Globalstar, for example. That's a $10.9 billion deal expected to close in 2027.
Right, and Globalstar isn't a cloud software company. They are a satellite company.
Exactly.
Amazon is heavily funding Project Leo, which is their proprietary satellite network. The filings say they already have over 250 satellites currently in orbit.
Yeah.
And they signed a deal with Delta Airlines to provide in-flight Wi-Fi beginning in 2028, and they are actively powering the satellite SOS and messaging services for Apple's iPhones and Apple Watches.
And the mechanism behind this space investment ties directly back to AWS. Currently, if you send data from your phone to the cloud, it has to bounce through cell towers and fiber optic networks owned by traditional telecom companies.
Right, like AT&T or Verizon.
Exactly. But by controlling a satellite constellation, Amazon can theoretically beam data from an iPhone directly into an AWS data center. They bypass the telecoms entirely. It is really all about controlling the end-to-end pipe.
Wow. And their ambition isn't just in orbit either. Down on the ground, the filings highlight Zoox, their autonomous vehicle division.
Oh yeah, Zoox is fascinating.
They are testing purpose-built robo-taxis in Miami and Austin right now. They've logged nearly 2 million miles, and they just announced a massive partnership to put Zoox vehicles directly onto the Uber app.
The through line connecting all of this, the AI silicon, the satellites, the autonomous vehicles, is that Amazon is attempting to become the invisible layer powering absolutely everything.
Right.
The free cash flow is down 95%.
Right.
Because they're actively building the infrastructure of the 2030s.
It feels like Amazon looked at our physical world and said, we deliver the packages on the ground, but now we want to provide the internet from space and drive the car that takes you to work. They want to be the operating system of the physical world.
That's a really good way to frame it.
You use their satellite network to connect your phone, you hail their autonomous car to get to work, and while you are riding, you are interacting with AI models trained on their custom silicon in their data centers.
However, as an analyst, it is critical to point out that this vision is incredibly vulnerable.
Oh, for sure.
Because the SEC mandates that companies explicitly lift their risks, right? And the 10Q goes into deep detail about the dangers of unproven technologies and the reliance on regulatory approvals.
None of this is guaranteed.
Exactly. Project Leo and Zoox are not guaranteed to succeed. Launching thousands of satellites and navigating robotaxis through complex urban environments, those involve immense regulatory friction, catastrophic engineering risks, and obviously massive upfront capital. These are very high-risk bets that could easily fail.
So what does this all mean? If you're a customer relying on Amazon to order, paper towels or a new phone charger right now, you might be listening to this and wondering how a retail store pays for a space program and an autonomous vehicle fleet.
Yeah, it sounds crazy.
With all these shiny new sci-fi toys, is the retail store just a side hustle now? Or is it the engine paying for the rocket fuel?
If we connect this to the bigger picture, it is very much the engine. Far from being a side hustle, the retail and advertising divisions are the essential engines making the science fiction possible.
Okay, let's look at the numbers.
Yeah, if we look at the core retail numbers, they are remarkably resilient. North America sales hit $104.1 billion, up 12%. International sales hit $39.8 billion, up 19%.
Wow.
And the crucial metric overall unit growth,
Right.
which is the actual volume of physical items they are moving, that hit 15%. That is the highest unit growth they have seen since the pandemic lockdowns.
And they are quietly integrating this massive AI investment directly into that retail experience, too.
They are.
The earnings release highlights Rufus, their AI shopping assistant, which is now actively guiding consumer purchases. But what really stood out to me was Creative Agent, an AI tool they rolled out across Europe and Canada.
That tool is so smart.
It really is. It actually builds full optimized ad campaigns for small businesses right on their platform.
And that specific tool is a perfect example of lowering the barrier to entry. If you make it completely effortless for small sellers to buy ads, you feed their advertising business.
Right.
And that advertising segment just crossed $70 billion in trailing 12-month revenue. Advertising is a very high-margin business, unlike shipping heavy cardboard boxes.
Sure.
That $70 billion is nearly pure profit compared to the retail side.
And the integration doesn't even stop there. They are pushing heavily into healthcare with Health AI, backed by their acquisition of One Medical.
Oh yeah, that's a big move.
It acts as a 247 personal health agent managing appointments and prescriptions, which help drive a near tripling of virtual care visits year over year. And of course, their logistics network keeps accelerating.
Unbelievably fast.
Yeah. 1 hour and 3 hour delivery options now cover over 90,000 products, and their Amazon pharmacy deliveries for GLP-1 weight loss drugs are expanding to 4,500 cities.
Wow.
Even their entertainment division is pulling its weight. The movie Project Hail Mary generated $615 million at the global box office.
So when we piece together the entire balance sheet, the dynamic is actually really clear.
Yeah.
The traditional retail business, combined with that incredibly lucrative $70 billion advertising behemoth, generates the daily reliable cash flow required to tolerate a $147 billion capital expenditure bill.
Right.
Without the consumer consistently buying household goods and clicking on sponsored products, Amazon simply cannot afford to write a $15 billion check to OpenAI or buy an entire satellite company.
So what does this all mean for you, navigating this landscape? Let's recap what we've uncovered today.
Yeah, let's summarize.
We started by looking at a headline claiming a massive $181 billion quarter. We used our bot check to verify the operational reality, revealing that a $16.8 billion chunk of their net income was actually just a paper game accounting illusion tied to Anthropic.
Right.
But peeling back that layer exposed the real story here. Amazon is undergoing a profound metamorphosis. They are transitioning from being the everything store to the everything infrastructure.
That's the perfect way to phrase it.
They are funding the AI revolution to guarantee a monopoly on the underlying compute power, and they are launching satellites to literally own the pipes our data travels through.
And that infrastructure shift brings up a final critical concept for you to consider.
What's that?
Well, when reading through the risk factors in the 10Q, the document repeatedly warns about the dangers of system interruptions and a potential lack of redundancy.
Right. They have to disclose that.
Essentially, they are acknowledging the catastrophic risk if their systems go down.
Which is a terrifying thought when you realize the absolute scale of what they are hosting.
Exactly.
Yeah.
Just consider the dependencies we've discussed today.
Yeah.
Amazon is currently weaving itself into the deepest layers of our global infrastructure. They are powering Meta's workloads. They are hosting the models for OpenAI and Anthropic.
Yeah.
They are providing the emergency satellite connectivity for Apple's iPhones. They are managing the logistical supply chains for millions of small and medium businesses globally. They are no longer just a storefront you can choose to ignore.
They're becoming the foundation everything else sits on.
Which leaves us with a really provocative question to mull over. If a private corporation successfully transitions from being a convenient consumer service to becoming an indispensable end-to-end global utility, at what point do they become too critical to fail?
Wow. Yeah.
And how will global regulators eventually respond when a single entity holds the keys to the world's compute, its commerce, and its connectivity?
That is exactly why we have to look past the glossy press releases and dig into the actual SEC filings. Thank you for joining us on this deep dive into the sources. Keep verifying the data and always question the headlines.